In today's video, we're going to talk about the top 5 states retirees are currently moving to and talk about some of the reasons why. Are they searching for lower costs to stretch their retirement assets further? Or are they simply looking for warmer weather? If you're thinking about moving in retirement, we're going to discuss some less common variables that should weigh into your decision making. One of the major reasons older Americans move in retirement is costs. One of the biggest retirement expenses is taxes. Now, a mistake I see a lot of people make is they simply focus on the state income tax in order to look at the costs of a given state. But income tax is just one branch of the tree of total costs. We recently recorded a video talking through 5 layers of taxes a state might levy on you. But we are going to further expand on these variables in today's video. By the end of this video, I'm going to give you a framework that you can use to analyze the total costs of a given state for your situation. Now, the one area that won't directly be included in this framework is preference. For instance, if you want warmer weather and to live by an ocean, well, I'm sorry, but Iowa isn't going to work out even if it's an extremely affordable retirement state. So, disclaimer off the front end here. I'm going to focus primarily on costs in this video because there's no way I can reliably include preferences in this analysis. Now, as we go through aggregating together certain variables, know that some variables can be a little tricky. Take something like property taxes. Sometimes a state with low income taxes might offset that with higher property taxes. So if we really care about costs and stretching our assets as far as they can go, this is an area we should care a lot about. We can start by looking at average property tax rate in the state. But that's just looking at the first layer. And we might think that Florida is more cost effective than Michigan in this example. But what is the tax rate being applied to? Meaning, what is the cost of housing in that state? If the cost of housing is the same in each state, then yes, we can focus just on the tax rate. But the reality is housing prices vary quite widely around the country. For instance, even though Michigan has the highest property tax rate in this example, it has more affordable housing costs. And so when we add in this second layer, we can see our conclusion might vary quite significantly. And part of the difficulty in assessing whether one state is more affordable than the other is that there are a few variables like this. Cost of living would be a perfect example. Let's say you could live comfortably on $70,000 in one state, but it would cost $100,000 to have an equivalent life in another state. Well, the second state could have lower income tax rates than the first state, but even with lower rates, you might actually pay more in total taxes in the second state because you're forced to withdraw more to live on because of the higher cost of living. So again, some of these variables can be a little bit tricky, but let's talk about the top 5 states retirees are moving to and the top 5 states retirees are currently leaving. California and New York top the exodus list, and Florida and South Carolina are the top destinations retirees are currently moving to as of the end of 2023. This data is based on US Census data. Now, there are a lot of reasons retirees are leaving one destination and potentially moving to another, but cost and affordability seem to be a major variable. For instance, of the top 5 states retirees are moving to, 3 of the top 5 states, Florida, Texas, and Washington, do not have a state income tax. But as we discussed at the beginning, income tax is only one variable that you should care about. So let's analyze this a bit deeper and see if these 5 states are really more affordable than, well, these other 5 states. The first variable we are going to discuss is cost of living. Now, one thing I want to say on the front end is that any time that we're doing a general analysis, like the one in this video, I am forced to use some, let's say, general assumptions. For instance, when I look at the cost of living in New York, the locale that you are living in can vary the cost of living quite widely. For example, the cost of living in New York City will be different than living in, let's say, Woodstock, New York. The more granular that you can get in the variables that you are personalizing to your situation, the more beneficial an analysis will be for you. But on a broad basis, we see a big gap in cost of living. This cost of living data is based on Bureau of Labor data for those over 65 and includes annual spending on groceries, gas and transportation, shelter, annual spending on healthcare, and a number of other categories. In the first column, I have what the cost of living will be in what I refer to as a basic retirement. This would be just meeting the basic cost of living in that given state with very little discretionary income to enjoy beyond this. Then in the second column, I increase this amount by 50%, and label it as a more comfortable retirement. This would be an example of having a larger discretionary budget that's tacked on top of this. On average, if we are looking at the states retirees are flocking to, the difference in cost of living is roughly $4,500 if we were just looking at a basic retirement. But again, it all depends on what state you are leaving and what state you would be moving to. One thing not included in this cost of living analysis was taxes. When we are withdrawing income to live on, certain states can cost us far more than others. Now, most viewers would expect a state like California, whose income tax rate can rise as high as 12%, to be much more costly from an income tax standpoint than, let's say, Texas, that has no income tax. And that can be true, but it entirely depends. If we focus on the basic retirement column, we can see that high tax states can actually have quite low taxes. Living on approximately $81,000 in California would cost a single retiree about $244 in income taxes if they had a $25,000 Social Security benefit and were taking the rest of their income from IRA assets, so completely taxed assets. And this is because a state like California has a very progressive tax system. At higher income, yes, you can be forced to pay a ton in income taxes, but at lower income levels, California can be quite cheap in terms of income taxes. In a more comfortable retirement, now California looks quite expensive compared to other states. The costs of a high tax state, along with higher costs of living, really start to weigh on retirees considering which state they should live in. But again, state income taxes can be a tricky variable. Say you are comfortable living on a more basic retirement budget and the income numbers that we showed a little bit earlier. But let's say that you have also done a great job accumulating assets inside of, let's say, tax-deferred accounts. Well, in your 70s, whether you want to or not, you are going to be forced to withdraw money from those tax-deferred accounts in the form of required minimum distributions. Or you will be forced to get ahead of the tax problems that RMDs will force, and you'll be forced to do Roth conversions earlier in retirement. In both of these cases, you will be forced to take out much more income than you maybe otherwise would want or need to live on. Because of this, this will push you into higher and higher tax rates in a more progressive tax system. So you not only need to look at the taxes you'll be forced to pay on your basic living expenses, but also taxes you may be forced to pay when required minimum distributions start. In a state like California, this can change the actual cost of state income taxes quite drastically. Next, let's move on to some other taxes you might need to consider. First, none of the states listed tax Social Security, but some states do. Then, a variable that may or may not apply to you would be state estate tax. If you are someone with sizable retirement assets and want to leave quite a bit to the next generation, know that some states will charge a state estate tax at some relatively low levels. There are 2 states on our list that do, New York and Washington. So a state like Washington might charge you no income tax while living there, but your wealth may be hit with a big tax bill at your passing if you're not careful. Then we have sales tax. Sales tax is another one of those sneaky taxes that states will use to offset higher or lower income taxes. But the thing is, sales tax only applies to a set of spending. Some states charge sales tax on groceries, others won't. Some states won't charge sales tax on certain services, others will. The National Conference of State Legislatures also shows that the amount of your income that is spent on sales taxed items varies by income. Lower income deciles may spend as much as 3/4 of their income on sales taxed items, where higher incomes spend as low as 1/6 of their income on similar goods. For our assumptions, we're going to average out the cost of living in both the basic and comfortable retirement columns. We are then going to apply an assumption on how much of the income is spent on sales tax items. For a basic retirement, we're going to assume 70% of spending is on those sales tax items. For a comfortable retirement, we're going to use a 55% assumption there. With these assumptions, we will see there are gaps on a state-by-state basis, but the difference between each state is much smaller than, say, the income tax or property tax comparisons. Washington, New York, and California take the top spots for the most expensive states in this given category. Virginia comes in as the lowest sales tax state. Then finally, we get to real estate costs. And this is a category where we will see some big gaps. Now, there's always a question of what data we should use in this analysis. Should you use the, let's say, median value of houses based on tax assessments? Should you use the median value of houses based on current prices and sales? Now, in this video, we've chosen to go the latter route. There has been some significant price appreciation in housing over the last few years. And if you're looking at moving in retirement, I'm going to assume you don't already have a second home that you will simply be moving into. So current prices are what you care most about in this context. As discussed earlier, in assessing housing costs, we care both about the cost of the house, but then also the ongoing property tax rate as well. States like Virginia and Florida can have reasonably high median house prices, but are fairly affordable when we talk about tax costs because of that lower tax rate. On the flip side, places like New York and New Jersey have both high housing costs and high property tax rates, leading to costs nearly triple what most other states would be. So this is a substantial variable to consider within your search for the best state for you. Now, as we total up all of this data and come to an index of sorts for what each state would cost to live in, know that I decided to leave out the housing cost information that I just showed. I wanted to avoid double counting housing costs, as housing costs were technically already built into the cost of living assumption that we used earlier. Now, I think the cost of living numbers probably underestimate housing costs for someone buying in today's market, but I don't think double counting was a solution either. But outside of that, let's take a look at what a basic retirement would look like in each of these states. If we compare both of these groups, we will see that there's a clear savings between average costs. The 5 states retirees are leaving are nearly 8% more expensive on average than the states retirees are flocking to. But context matters here. If we take out New York and California, we see that costs are much more similar. And so in many cases, choosing to live in Virginia versus South Carolina will be much less impactful from a pure cost standpoint. And this should be great news for many retirees, as they can focus more on non-financial factors like preference. What do you want in retirement? What type of climate do you enjoy the most? Where is your community? But if you're someone who lives in California or New York for your working careers, you will find that your money can go much further by making a move to a more cost-effective state. When comparing these numbers in a more comfortable retirement context, know that the gaps grow even further apart. Now we see a nearly 10% gap in costs to maintain a similar lifestyle. But the gap from a state like California to a state like Ohio or Texas is an over 50% difference in income need. So a similar message applies as we scale up the income. Many states, or at least 6 of the states that we went through here, will have very similar costs across the board. That would be Virginia, Ohio, Pennsylvania, Florida, South Carolina, and Texas. New Jersey and Washington, costs can certainly start to creep up a little bit higher, specifically in the housing cost side of the equation. And New York and California are the outliers, where one will certainly need to have more saved up in order to maintain the same comfortable lifestyle in these 2 states. Now, if you like this analysis and would like to see more states covered in a similar framework, let us know in the comments below. Also, if you think we missed something, let us know that as well. If you're wanting to watch our previous video on 5 state tax considerations outside of just the income tax, click on this video right here where we take a look at tax systems on a more broad basis. Thanks for watching, and always remember, you don't need more money, you need a better plan. We look forward to seeing you in the next video.